Why do bond prices fall when interest rates rise? You've probably heard that phrase before. Maybe in the news, maybe from an investment advisor. But how many people actually understand why that happens? And more importantly, by how much do they fall? Today, we're not just going to repeat the old saying. We're going to break it down, layer by layer. Because at the heart of it lies a powerful and elegant piece of financial math that governs trillions of dollars in the global economy. Two key ideas: duration and convexity. They might sound complex, and they certainly do show up in CFA exams and investment textbooks. But when you strip away the jargon, these tools offer something incredibly practical. A clear way to understand how interest rate changes impact bond prices. And if you think this only applies to central banks or massive pension funds, think again. If you're investing in retirement accounts, mutual funds, or ETFs with bond exposure, this matters to you. In fact, these two concepts are so fundamental that every serious fixed-income portfolio manager, bond analyst, and even many governments rely on them daily. This video won't just help you understand a chart. It will help you understand the foundation of modern bond markets. Let's unlock it together. Duration is one of the most misunderstood metrics in bond investing. People often confuse it with maturity. Yes, both are measured in years. But while maturity is the number of years until the bond repays its principal, duration is far more insightful. Duration tells us how much a bond's price is expected to change, in percentage terms, for a 1% change in interest rates. In essence, it's the sensitivity gauge of a bond. Let's say you hold a bond with a duration of 7. If interest rates rise 1%, the bond's price may fall by around 7%. A similar bond with a longer duration might fall by 12% or more. Duration captures that sensitivity. Longer duration means greater interest rate risk. This is why asset managers fine-tune portfolio duration depending on rate outlooks. During volatile times, they shorten duration. In stable environments, they might extend it for better yield. There are even products like target duration ETFs that let individual investors select their interest rate sensitivity. And duration isn't static. It depends on more than maturity. A bond's coupon also plays a key role. Higher coupons return cash earlier, reducing duration. That's why zero-coupon bonds, which pay nothing until maturity, have the highest durations for their terms. Even more nuanced is how credit spreads interact with duration. If you're managing a portfolio with corporate or emerging market bonds, changes in credit risk can amplify interest rate impacts. Here's a helpful way to visualize duration in practice. Think of it like a seesaw. On one end are your early coupon payments. On the other, the lump sum at maturity. The longer the bond, or the smaller the coupons, the more the seesaw tilts. Duration is that balance point. Ultimately, duration is not just a number. It's a strategic lever that helps investors position themselves for rate changes while balancing income and capital preservation. Let's add a quick example to make this more tangible. Imagine two bonds with the same duration of 6. One is a traditional bond, the other is callable. If interest rates drop sharply, the callable bond may not rise in price as much, because it might be called early. This shows how duration misses the risk from embedded options, and why convexity matters. While duration is powerful, it's still just an estimate. It assumes a linear relationship between bond prices and interest rates. But in reality, that relationship is curved. That's where convexity enters the picture. As interest rates change, duration itself changes. The bond's price doesn't follow a straight line. It curves. This curve is what we call convexity. Let's say a bond has a duration of 6. If interest rates rise 2%, you'd expect a 12% loss. but in reality it might be 13.2%. That's convexity in action. It adjusts the duration estimate to reflect real market behavior. This is especially critical for instruments like callable bonds or mortgage-backed securities. These securities have built-in options, making cash flows unpredictable when rates shift. Duration alone fails to capture those effects. Convexity also helps during large rate moves. It minimizes surprises. When rates fall sharply, high convexity bonds rise faster than duration alone predicts. When rates jump, they fall less. The takeaway? Duration handles small changes. Convexity handles the big swings. Convexity is the rate at which duration itself changes. Think of duration as your car's speed, and convexity as the way you accelerate or brake into turns. In volatile markets, convexity is a buffer. Investors often accept slightly lower yields in exchange for better convexity. And like duration, convexity can also be negative. This happens in mortgage-backed securities when prepayments spike as rates drop. That optionality cuts upside, reducing price gains even as rates fall. Convexity turns bond risk into a three-dimensional picture, helping you prepare not just for what happens, but how sharply it happens. These concepts aren't academic. They shape portfolios in the real world. Let's take pension funds as an example. They often match long-duration bonds with long-term liabilities, like future retirement payments due 20 or 30 years later. By aligning cash flows this way, they reduce risk and improve predictability. Central banks, pension funds, and insurance companies rely on duration and convexity to align assets with liabilities. Even equity investors benefit. Duration and convexity affect discount rates, which in turn affect valuation models. What happens when the models break? During the 2008 financial crisis, many mortgage-backed securities with high negative convexity dropped dramatically in value, even when underlying mortgages didn't default. Some funds lost over 30% in a quarter, not because of credit defaults, but because of poor convexity risk management. In a crisis, bonds don't behave normally. Liquidity dries up, and even safe assets behave unpredictably. In 2008, funds with complex convexity exposure, especially negative convexity, were hit hardest. The lesson: in chaos, convexity becomes more than math. It becomes survival. Bond investing isn't just about picking what pays the most. It's about understanding what you're exposed to. Duration shows how bonds respond to interest rate shifts. Convexity makes that estimate more accurate in volatile conditions. Together, they're like a GPS and suspension system. One guides, the other cushions. If you're investing in bonds, even through a 401k or ETF, duration and convexity are silently shaping your returns. Hit subscribe to decode more hidden financial forces in 10 minutes. And in the comments, let us know. Have you ever looked at a bond fund's duration before investing? What surprised you most? Tag someone who manages their own investments. This is the bond math even advisors forget to explain. This is Finance in 10. Complex finance made simple in just 10 minutes.